First of all, thank you for joining in. Today, we're going to talk about the impact of tariffs on the textile sector. So, this is one of the sectors which is one of the worst hit due to these US tariffs, right? Because majority of the big textile players are, exporters, and one of the key markets that they export to is US, right? Uh, yeah, let's start off. So the agenda is to understand what US tariff escalation looks like and what the new landscape can look like. We will also assess what the impact on various companies is. The impact is not the same for everyone. It's slightly differentiated based on their business model. We'll also see company specific analysis, who could be the winners, who could be the losers due to this. The mitigation strategies that many of these companies are trying to implement given this new norm as of now. The margin impact and outlook. So a lot of companies have reported margin pressure, and what are they doing to sort of abate it? Competitive positioning and key takeaways. So yeah, that's the agenda. So firstly, I want you guys to understand that the significance of the US market. So US is one of the biggest markets when it comes to textile exports. So it's the second largest, right, in terms of textile exports. So if you look at this pie chart on the left, it's 16% of the global market of apparels, right? And that's right just after EU 27. So EU 27 is another big market, but where we don't have tariffs as of now, but our peers like Bangladesh and a couple of others have some duty-free access. So which is reducing now with the UK FTA, but EU 27 is one of the other big markets, right? Along with US. China again is a 10% market, but they have their own manufacturing base, so it's not an export market for India. So just want you to understand that US is one of the major markets for exports for Indian players. Yeah. And this slide here, if we look at it, so the this is Indian apparel export share, right, to various countries. So if we look at US, US is close to 5.3 billion USD, right? So if we see for India, that's again the second largest after EU. So EU is 6 billion, right? And US is 5.3 billion out of the 16 billion exports that India does in apparel. So uh, again, coming to the same point. And if you look at the geographical share, again, after EU, US is 33% of the market, which is actually steadily growing. So it was close to 27%, which is now stable at 33% in 2025. So let's look at what happened. So the first phase was April to May. Initially, 26% reciprocal tariffs were announced on Indian goods, right, on 2nd April. Then on 5th April, there was a 10% baseline tariff on all imports. So this was across geographies. So there was a restriction and there was a 10% baseline tariff. But what this did is that created a lot of uncertainty, and buyers were hesitating to place orders. So the impact of this was that a lot of retailers in the US and a lot of buyers, customers in the US, they sort of downtraded the goods, or downtraded the goods that they were buying, and delayed orders. So they were waiting for some clarity. Then the second phase was June to July. So on July 8th, there was a slight extension given on the tariffs, which provided some sort of a temporary relief and some adjustment time. Buyers also, the US buyers also, started making their own contingency plan. They tried alternative sources. But the impact of that again was there was some respite, there was some business going on, but with higher tariffs. And then the third and the final phase. So I think from August onwards, there was a 25% tariff effective. But on August 27, this is when one of the major hits, came in for the Indian exporters. Is that India had a 25% incremental or a penal tariff versus the other peers who did not have this. And till today, the tariffs remain elevated. There are a lot of positive talks on that front, but no resolution as of now. So what's the summary? There was a sudden severe 50% tariff, US tariff shock that disrupted Indian textile exports ecosystem. Right, there was a rapid escalation of tariffs over the last 5 months, which put Indian exporters at a disadvantage versus the competing nations, which are Vietnam, Bangladesh, and China. Uh, but all companies, as I said, all companies did not have the same impact. There are a few asset-heavy India manufacturing focused companies which had a slightly higher impact versus a few other players who are asset light or who have manufacturing locations in other geographies as well. Uh, Again, what the companies are trying to do is they are trying to realign their global supply chains, and then they are also trying to move towards friendshoring. Friendshoring is basically moving manufacturing to locations where the tariffs are lower. The outlook is that margin pressure will persist in the near term, and a few companies are trying to mitigate this by few factors like friendshoring. So the tariff landscape looks like this. These are a few of the major exporting nations of textiles. So China is again at higher than us. It's at 54. India is at 50. The other major ones, which is Bangladesh and Vietnam, they are both at 20%, which makes India at 30% disadvantage versus the other competing nations, which is Bangladesh and Vietnam, who also export a majority share to US. The others, Sri Lanka, Indonesia again, and Pakistan, they all are at 19 to 20%, which puts India at a disadvantage. So why the 50% tariff on India? So 25% was the reciprocal tariff, and 25% was the additional penal tariff, and this was as mentioned by Mr. Trump, was because of India purchases Russian oil, right? What was the impact of this? That there was a direct cost increase for the US retailers that eroded their margins as well as the suppliers' margins. So when such a big tariff impact comes in, the entire value chain has to bear it. It's not that one part of the value chain will bear it and they can get away with it. So even the consumers, even the retailers, even the suppliers, all were bearing the tariffs, and they still are. Uh, it also reduces the competitiveness versus Bangladesh, Vietnam, as I said. Uh, yeah. So if we look at major Indian companies, be it in home textiles or apparel exports, exporting to the US, this is the revenue contribution from the US, right? So Gokuldas exports is at the highest 70 to 75%. Indocount is again at 70%. It's a home textile company. Wellspun Living, again a home textile play, is at 60-65%. Himmat Singha is at 60%. Core Global is at 50% on a group level. So what by when I've written group, it means that basically the revenue exposure is 50%, but the goods manufactured in India to export to the US is lower than that. It's close to I think 16-17%. So the others are manufactured in other locations because Pearl Global as a business model has different manufacturing locations. KPR is 20 and PDS is less than that 16. So there was a sector-wide squeeze in margins in Q1. Q2 results are also out, and there is a slide in the end for that because this just came in last week. But there was a sector-wide squeeze in margins. So if you look at Wellspin, significant contraction, 400 basis points. There is operational deleverage as well. So as I said that the US retailers are down trading goods and also placing orders, lower orders, which also leads to operational deleverage. So Westman Living had a major impact on margins. They have had it in Q2 as well. Indo count again, margins fell from 16 to 12. Again in Q2, the margins are further down. Gokuldas again, they've claimed that 2 to 2.5% of the margin hit is due to tariffs. Again in Q2, they were severely hit. And PDS also had problems on the gross margin front, and they mentioned that there were market disruptions which caused this. This primarily US market disruption. So the outlook on margins is near term, which is H1, which is over now. The margin pressure is expected to persist, right? And this was made before the Q2 results were out, but near term margin pressure is expected to persist even in Q3 if the deal is not signed and the entire Q3 India bears a 50% tariff. There will be a margin impact in Q3 as well. But there's a hope for recovery. There are a lot of positive talks going on for the US India deal, and if that is signed, then medium term there is a hope for recovery in H2 or Q4. And the CEO of Westman Living characterized the situation as temporary. Yeah. So coming to the differentiated business models, so the first one is I think that this one is better poised to handle this tariff situation because it's an asset light play, it's a platform play. So PDS as a business model, they have some manufacturing presence, but the majority or the bulk of the business model is that is a more of a sourcing platform. So PDS as a business model helps retailers source garments from various geographies. They help with designing, planning, and a few other value add services. But it's majority low margin business, and it's a sourcing business, and it's an asset light business. So they connect retailers with the vast network of partners that they have, partner factories. So for them, the impact was, from the US tariff was slightly minimal because if we look at their US sales, right, where everyone was reporting a decline in US sales, PDS actually reported a 25% year-on-year growth in H1 FY26 in US sales. So that's completely contrary to what one would think because of these impacts. But US business grew for PDS and had a very strong 25% year-on-year. The strategy is that when 50% tariff hit, there was a hit on India, PDS simply shifted US orders from India to other partners. So they will have partners across the world. They will have partners in Bangladesh, Vietnam, China, Indonesia, and other many nations. So what they will do is they will source it from other nations rather than India, which is very easy for them since they don't have manufacturing in India, which is asset light. So I think they are well positioned and they have a clear competitive advantage in the current scenario, uh, which the others don't have. The other one is Pearl Global. So again, the benefit with Pearl Global is that they are a multi-country manufacturer. So they have manufacturing presence in other countries as well. One of the major countries where they have presence is Bangladesh. Uh, the other is Vietnam, Indonesia, and Guatemala. So again, so when I mentioned that 50% US exposure, only 16 to 18% of its US business was produced in India, right? The other US business or the other business that is in US was made from probably factories in Bangladesh, Vietnam, or other nations, right? So they also have a slightly minimal impact. And what they're doing is that the 16 to 18% of the business also that is manufactured in India for the US clients, they are shifting it to other locations, which they can do, right? So that's their strategy. And again, because they have manufacturing presence in other nations, they can do this, and I think they are better poised than the others who have a heavy India-centric manufacturing. On the right, if you look at this table, it's just a table of Pearl Global's manufacturing capacity. If you look at the total manufacturing annual capacity they have, as this is as of FY25, they have 93 million pieces. Okay, and out of 93 million pieces, only 24.5 million pieces, just only 26% of the capacity is in India, and 60% of the capacity is in Bangladesh. So a lot of their capacity is outside India. And even incrementally, I think where they are expanding, a lot of expansion is happening in Bangladesh, and there is some expansion in India as well. Yeah, KPR again, they have lower US dependence, sorts of less than 20%. The other benefit to KPR is that they are a vertical integrated player, which means that, so I've explained this in my previous webinar of overview to textiles, the value chain of textiles basically. They also do spinning, which is from cotton to the yarn. So they have their own spinning units, they make their own fabric, and then they also make their own garments. It's a completely vertical integrated textile player, and also it has low dependence on US. They have a major exposure to the Europe, right? So their largest exposure is to Europe, and then they also have this yarn segment, which I mentioned. They also have a sugar segment. So the dependence on US is low. Even after that, they are vertically integrated. Even after that, right, they have other segments to cushion this impact. So again, their strategy till there is no clarity on the deal or the US tariffs, they'll try to increase their exposure to Europe, other markets like Europe, Japan, Australia. Also, they have a decent presence. Uh, right. So I think KPR is not significantly winning from the crisis because they were also trying to increase their US business, but it's well protected versus the others. Now, coming to the challenge category. So, challenge category, I've put the companies who are India-centric manufacturers with a high US exposure, who are facing currently the full brunt of the tariff shock. Uh, so again, Gokuldas. Why I have written it's a slightly hedged manufacturer. The only reason for that is last year they acquired this company, African company, and so then they have a few African manufacturing units as well in Kenya and Ethiopia. But till they did not do the acquisition, they were completely India focused. So again, primarily they are an India-focused manufacturer. Offshore subsidiaries, they have manufacturing units now in Kenya and Ethiopia and a few African markets. Uh, Impact is actually slightly moderate to severe only on Gokuldas because most of the capacity is in India. Q1 margins were hit because they had to provide discounts to US clients. Further, there was a further hit on margins in Q2. The management on the con call mentioned that they are providing close to 15-16% discount to the US clients, uh, which is significant if you look at their margin profile. Uh, and again, what they're trying to do is they're shifting US orders to African units, which only face 10% tariff, by the way. So in one of the Kenyan subsidiaries, they also have this AGOA Act, right, which is the act between Africa and US, where there was some duty-free access, which is expiring this year, but there are talks to extend it. Nevertheless, even without AGOA, these African units are at an advantage even to Bangladesh and Vietnam because they only have a 10% tariff. So the African order book for Gokuldas is shaping up very well because this geography is at a clear advantage versus the others. While the ones that are being manufactured from India, there has to be a significant discount given to the retailers by Gokuldas. So yeah, it's not fully insulated. I would say not even fully. There's a significant burden on Gokuldas as of now, but there is the African units that provide some sort of a hedge to Gokuldas. Now coming to the other home textile players who are challenged slightly more. So Wellspun Living, I think Q1 revenues were also down close to 12%. EBITDA margins, as I said, dropped 400 basis points. US orders were deferred. What they are trying or what they announced is that they are setting up a pillow manufacturing plant in US. That, by the way, even Endocount is doing. Uh, again, manufacturing in the US is one thing that they are doing. They are also trying to increase sales from the Indian market, which is currently very small. The other thing that they're also trying to do is target the UK and EU market. So a lot of these guys are talking about increasing UK share, especially from next year. The UK FTA will get implemented, and India will have duty-free access to the UK. So that becomes a very interesting medium-term opportunity for these guys. UK as a market is again a decent sized market. Till now, India had very low share because we had duty, but now that duty goes away with the FTA. So that is one area of mitigation which these guys are exploring. Again, the positioning for them is currently they are challenged, but they are trying their best they can to diversify. And they are also making a few investments, like I said, the pillow manufacturing in the US. Indocount, the second one, again, they are severely hit. Right. What they have been mentioning in the con calls is that the clients are, down trading goods, which is also having an impact on gross margins. The orders are being deferred, so there are volume declines. Margins are under pressure because of tariff sharing. Again, they have so now they have three facilities in the US of pillows, right? Two they acquired last year. One is a greenfield, which will start anytime in Q3, Q4. And one thing that Indocount is doing over the last few years is their focus on brands has increased significantly. So they acquired this brand called Vamsuta, right, from the Bed Button Beyond brand. And apart from that, also they have other 6 to 7 brands, and they are trying to increase the share of their branded products. Uh, they also launched Vamsuta last quarter as a D2C brand in the US. So they are focusing significantly on the branded play, which even Wellspun has. But Indocount in the last few years has been significantly increasing the branded product presence in the US. The positioning for them again, they are vulnerable, but they are also being slightly more agile. They are also diversifying away from the US into, as I said, UK is one market that everyone is looking at along with other markets. And as I said, that they have now those other pillow manufacturing or utility bedding, that is called. They have that segment, which is basically keeping their top line. That part is growing, whereas the base business, core business is declining, which is keeping their top line slightly flat rather than a declining trend. The third, exporter, home textile exporter is Himmat Singha. So they have had a very severe impact again. Their sheeting utilization also dropped to 60% levels. I think they were 80% plus. Q1 revenue was down 10%. The other problem with Himmat Singha, I mean, as a company problem, or the other thing that that they have is they have a significant debt on books, right? And what they are trying to do is what they mentioned in the calls is that they are doing a cost control program. But so Himmat Singha, despite they also have branded presence, despite these tariffs, they have had a slightly muted impact on margins. So they margins fell again from 20% plus to 19, and this quarter again 18. But they are doing aggressive cost cutting, is what they've said, which has led to these margins. Uh, so again, they are at a risk. US being the biggest market, they have high debt, which is another problem, and this they don't have any other overseas hedge like the others. So this is one of the most vulnerable companies, right? So what are the mitigation strategies? I think immediate strategies what these guys have used, or what they're trying to do is pricing strategy. So they have discussed with the retailers, they have done their negotiations. They are trying to offset by doing a 40/60 tariff distribution. Uh, the retailers are also bearing significant portion of it. They are also trying to bear. They are also passing on to their value chain, like from where they buy the raw materials. They are passing on some hit to them as well. So the impact is being felt across the value chain. Uh, they're also trying to do inventory management. Some orders are being shipped early, right? When the 50% was not in implementation, a few of them shipped the orders early so that they can clear the US warehouse in time. And again, there are discussions on costs, and they are taking a hit to maintain the long-term relationship with the clients. Geographic diversification, as I said, medium term UK FTA is one of a very good opportunity for the US, for the Indian textile players. Even Australia, Japan markets, many of these guys are talking to expand. The other thing is, whoever can do this, I think a few of them, Pearl Global, PDS, Gokuldas can do this, is to shift US production to other geographies, let's say probably Bangladesh, Vietnam, or Africa for Gokuldas. And they are trying to mix, improve the product mix. So maybe try to sell more value-added products, more branded products. And I think the long term, if the tariffs are not, going to have any solution, I think the long term impact will be probably exploring other manufacturing locations to send to US directly. And again, more selling more of value added products like branded products, having their own D2C capabilities, and do a lot of brand development. So if we this is from 2025 start, textile stocks, this is the returns from the textile stocks. They have been under pressure. uh, if we this is just this was made slightly earlier, but if you just exclude the last week or so, I think the textile stocks have done slightly well. Again, I think it's mainly due to the news flow of US India deal. uh, but the textile stocks have been under pressure. If you see, most of them have given negative returns except for KPR, which has been at 8% positive. But year to date, textile stocks have been under significant pressure. Yeah, so this is Q2 comments from the management. What I've done is I've done a comparison of year-on-year and QOQ margins for all these textile players. So if we look at Indo count, the margins dropped from 15 to 10. Last quarter was 12. Western 12 to 6, halved margins. Last quarter was again 10. Gokuldas again, dropped to a multi-quarter low, 6%. Himmat Singha again went to 16% from 18% last quarter. KPR Mills was slightly steadier, 18-19% quarter on quarter. The interesting is Pearl Global and PDS. So if you look at Pearl Global and PDS, year on year, Pearl Global had a margin expansion. Even quarter on quarter, it was stable. And PDS, if you look at it, the margins, quarter on quarter, they improved significantly. So yeah, I think it was 1 point something, which went to 3. Uh, Again, so PDS, the more impact is company specific factors rather than, so tariff also does have some impact on them, but there are other European subsidiary issues which led to this margin drop and then margin revival for them as well. So they are also doing a cost control program with BCG. The comments made from various managements on the top line was that it will be steady to muted, given that US clients are downtrading or placing orders very cautiously. Uh, what they are also saying is that if for the entire Q3, if the deal is not signed, they will have to share the additional penal tariff. So till now, in quarter two, only 1 or 1.5 month of this 50% incremental, I mean 25% incremental tariff was being shared, and that led to this margin drop. So if you were to imagine that the entire quarter will have this impact, Q3, if the deal is not signed, then Q3 will be a significant hit again to margins, right? So they will have a further impact on that, uh, unless obviously a deal is signed in the near term. So this is again timeline of the U.S. India trade sentiment. What I'm trying to show you guys here is what the sentiment is like, what Mr. Trump has been saying, and what it looks like. So earlier, Trump referred to India as they have significant tariffs. India is a tariff king, uh, and that's not fair trade practice. And he was citing long-standing frustration with high duties on U.S. goods. Uh, After August, after we all know that there was 50% tariff implication, citing India's oil purchases from Russia, uh, and this marked a low point in bilateral trade relations between India and US. September again, talks resumed. President Trump tweeted that the talks have resumed. There's a resumption of negotiation. Called PM Modi a very good friend, and he said that they'll come to some path of resolution. November again, there is a lot of optimism. Uh, he also suggested that US is pretty close to a fair trade deal, right, and tariffs will be brought down at some point in time. So that's a timeline of sentiment going from bad to worse to slightly better to now optimism. Yeah, coming to our large cap product, True Blue. So the ithought way, our investment philosophy is we have long-term focus. There's a non-consensus investing as a bottom-up approach and high focus on risk management. What you're trying to capture in True Blue is again India's growth story and plus global champions rising from exports. The USP of True Blue is that it's a 100% pure large cap portfolio with Nifty 50 as a universe. There's a high active share, low churn. It's more of a buy and hold strategy, and there's zero fixed fees. Uh, yeah. So the four pillars: portfolio construction, profitability, growth, and valuation is something that we look at. Wanted to take you through the Nifty 50 constitution, right, over the years, and it's been nothing short of a roller coaster. So if you look at from 1995, 2005, and then March 2009, uh, power was one of the biggest weights in Nifty 50 at 41%, right, which increased from 11-12% in 1995. Similarly, telecom gained in March 9. It was close to 10%. If we fast forward to 2015, uh, there were other gainers. Again, power declined from 40 to 12, telecom from 10 to 2, and the winners were auto from 3.3 to 10, and healthcare from 2.5 to 7, as healthcare had a very good cycle right? The US generic cycle was there till 15-16. So healthcare again moved from 2.5 to 7.3. 4 years, again, March 2019, 4 years later, financial services was the one that gained steadily. It gained in 2015 as well, but steadily gained to 39, which is the high point for financials. So financial was the winner. And if you see healthcare, which was at 7, dropped to 2. Again, because of pricing pressure in the US, right? Uh, and cut to 2021, IT was one of the bigger winners. So there have been sectoral weight shifts in the Nifty, across over the years and across the board. And only 11 companies present in the Nifty 50 are there since inception. So these are the 11 companies that have been present in Nifty 50 since inception. Others have been churned in and out. So here, I try to put an example of two of the winners, right? L&T over the long term. So L&T, HUL, and Index. This is just an example that these are all very good things to have in your portfolio, L&T, HUL, and Index. But do you need them in the portfolio all the time? So if right, you were invested in L&T from 1993 to 2000, the 7-year CAGR would have been -1 for L&T. For HUL, on the other hand, it would have been at 28%, and for Index, it would have been 3%. Right? Uh, 8 years later, by 2008, the winner was only L&T. It was not HUL or it was not Index, right? And cut to 2019, which is 11 years later, again, HUL was the winner, not L&T and not Index. So if you would have done, if you would have been invested in L&T only since the last from 1993 to 2019, the CAGR was 13%. If it was HUL, it was 17%. If it was Index, it was 10%. But if you were, if you were, which is, very difficult, and that is where active stock picking comes into play. If you would have invested, I am not saying from the lowest point to the highest point, but even if you participated in the rallies of HUL, L&T, and HUL in the best possible periods, even the few years of it, you would have handsomely beat the index or the individual stocks. So this slide, we're trying to show that out of the 50, 23 stocks in Nifty are with less than 1% weight. So that's a significant, it's just a very long tail in Nifty. And this is the performance of various large cap funds versus index. So if we see over a 3-year and a 5-year period, only 25%, and over a 5-year period, only 7%, right? Only 7% of the funds have outperformed the index. And a lot of these large cap funds do a lot of index hugging. By index hugging, it means that it's more or less the same as the index. So if we see most of these large cap funds, they have a very high number of stocks. The beta is almost close to 1. Yeah. So Trueblue, as a fund, we have 24 stocks only, and all are large cap, of course. Yeah, this is a quote from Nassim Taleb in Skin in the Game. So we know with much more clarity what is bad and what is good, why negative is more powerful and less error prone than via positive. Yeah. So how we filter out the Nifty 50? So from the Nifty 50 universe, there's an elimination based on capital allocation, accounting, governance. Then the Trueblue universe also, we look at the business cycle, ROE versus growth matrix, valuation, and then a Trueblue portfolio is curated. Yeah, so this is the growth matrix, right? ROE versus growth. There are 4 buckets to it, and high growth, high ROE is the one we try to look at. Yeah, here are a few examples of large cap funds versus Trueblue drawdown. So Trueblue has been very resilient in terms of drawdown in various situations. So this was from June 2022. Where Nifty fell 17%. This is the performance on the left and right is of various other large cap funds. And then there is Trueblue, which fell 12%. Similar is an example of March 23, where Nifty was down 10%, Trueblue was down half of that, 5%, and the worst was 16%. Yeah, and again in March 25, I think Trueblue had a drawdown of 13.7, Nifty of 15.8. and this is the performance of other large cap fund. So it has been very resilient in terms of drawdowns, which gives you peace of mind in a volatile market. The endeavor should be 200 to 300 basis points above benchmark returns, and the time frame typically you should look at is 3-year rolling. The product suitability. The fund manager, obviously Mr. Shyam Sekhar, he has 3 decades of experience, and this is the team apart from Shyam sir, the fund management team, the research team, right, the strategy team, and this is the performance, of TrueBlue as of 31st October 2025. I think we have published this, across, and this is the key terms, 50 lakh investment, and there are 2 fee options. All right. Thank you again for joining in, and I hope uh, you could you had a good time. Thanks.